Howdy, Jacob here. Today we're looking at Diageo in the beverages industry, 71 billion market cap on 89 billion enterprise value. Looks like they've been around since 1886, headquartered in London, United Kingdom. They produce, market, and sell alcoholic beverages. They offer scotch, gin, vodka, rum, all the types of alcohol. Okay. They're they do Crown. Okay, under Johnny Walker, Crown, J&B, Buchanan's, Smirnoff, Ciroc, Kettle One, Captain Morgan, Bailey's. Dang, they own a lot of alcohol here. Okay. Um, their growth in revenue is not huge. It went down a little bit pre-COVID or from 2015 until COVID, but then has been consistently going up with the most recent year, just a 1% decline. The thing that I'm really loving is these margins. Almost a 30% operating margin is absolutely insane with a gross margin of 60%, meaning that a lot of the money that they invest is really hitting that bottom line with these return on invested capitals in the double digits. So that's great too. They do pay a big dividend though. It is a 3.2% yield. So that does take capital allocation away from other forms of reinvestment, but that's not bad for now. We'll look at that at the cash flow statement in a little bit. Balance sheet has $1.4 billion in cash on hand, cash-like products with 2.9 billion short-term debt and 18.6 billion long-term debt. So that debt could be a bit concerning to me. They do have more short-term debt due than cash on hand. So that's a little bit concerning to me. And it looks like they've consistently had short-term debt. I've said this before. It's not necessarily going to 100% deter me, but I knew when we did Deere Company, like John Deere, they also had short-term debt consistently. And I just don't like debt getting due within a year. It's alarming. And I know companies that have been around for a while very likely aren't going to be going under for anything like that, like, short-term debt being due if it's abysmal, but I just don't like it. It scares me. I've invested in a company that had short-term debt due, and they called it, and it was scary. It was definitely one of the worst investments I ever made. And so I've learned my lesson. And although the free cash flow calculator and earnings calculator can make it look like a buy, the balance sheet still has to be taken into consideration 100%. So let's look at what this debt is in relation to their free cash flow. So about 18 billion in debt in relation to generously 3 billion. You're looking at 6 times that. So they do have a lot of debt, and it looks like in the last 8 years or 7 years or so, they've only reduced debt once. Their use of capital allocation is mostly dividends, and that dividend pays out over 60% of their capital allocation, with a lot going to share repurchases as well, and then a bit to acquisitions. So they're funding their projects through debt, and that has an expiration date. Even though you can increase your free cash flow a bunch, it doesn't look like they even are. They had $3 billion of free cash flow over here, and they had sub $3 billion over here because their CapEx grew, but their cash from operations did not. So I am concerned about that. Absolutely. That's going to be incorporated into our assumptions here. So I do think that demand for alcohol is not going anywhere. They'll be able to make some acquisitions to get 4%. I do think that this enterprise value being a little higher than market cap is a little bit concerning to me, but I'll give them market average because I do think they have some dominance with some of those brands that they own. But I'm going to want a 17.5% return given that debt. Although they've been around for quite a while, they have a name to them. I want them to focus on debt reduction. I don't think they're going to do that, so that's going to have to give me a higher margin of safety here. Margins, all great. Free cash flow being lower does not make me happy, though. So maybe let's do 18 and 16 with a share change of 1% would be about 700 mil. They can probably reduce half of that. But again, I'd want this dividend to be cut in half. I don't think they'll do it, but I'd want them to, because I want them to have capital allocation available to make acquisitions that make sense. And then I also am reducing debt about 30% with their capital with these assumptions. So this is assuming roughly 30% to 30% of cash flow to debt reduction, a 15% or so to acquisition, maybe 15, 20% to share purchases, and just 30% to the dividend. I think that's what I'm comfortable with, and that's assuming the company's stock price needs to fall 61% before you get the return we're looking for here. So I think it's a fine company, but the balance sheet isn't extraordinarily attractive, and I have turned off an investment just because of the balance sheet, even with the screaming deal being said. So I hope you enjoy the video, and have a great rest of your day.